All righty, folks, it is official. The Fed has announced that we have a broken housing market. Actually, I want to read a quote that Lance Lambert highlighted yesterday from the Fed announcement. We're going to break down things, all things Fed, all things housing. And of course, we're going to talk about something super special called ResiDay. Pay attention for that. That'll be at the end. But here we go, Lance. Jerome Powell said the Fed can't fix the broken housing market. The market and government will need to do so. Lance, I feel vindicated. I was one of the first people to call the housing market broken. And now Jerome Powell is stealing my thunder by acknowledging the housing market is broken. What say you?
Yeah, exactly. A great Zuber call, and that's essentially what the Fed is acknowledging here, which is that, hey guys, you have a lot of expectations for housing to not be as unhealthy as it is today, but hey, the Fed, we can only do so much. That's kind of what the Fed is acknowledging there. Now, I think the Fed, and we could get into this more. They did acknowledge that the housing market could, the housing cycle could normalize more as rates come down a bit. But in terms of the supply of the market, Jerome Powell said, "Hey, it's not us. We can't build homes."
It's really, really funny because if we go back to Jackson Hole, or maybe it was the Fed meeting after Jackson Hole, he was talking about, the young home buyer and their need to get into the housing market and really making it seem like this rapid increase in interest rates was going to unlock price collapse and it would be better to buy a home. And, fast forward 2.5 years, that never transpired. All we did effectively, and a number just got reported today, crushed transactions. Another call that I said was coming and was right. We just posted existing home sales lowest of the cycle at 3.86 million, taking out the old low at 3.88. The housing market is just clearly broken because, in my opinion, the move up buyer is dead and you're missing those two transactions. They're not a seller and they're not a buyer, and the market's just broken.
Yeah, exactly. And so, are you okay if I share my screen
Yeah,
and go through
please go
my
ahead.
piece from yesterday?
Please. Now, just
So
so I know, as you pull this up, was this Resi Club free or was this only for pro members?
this is a free story
Oh,
that
awesome.
I did for everybody in the audience. Give me a second here.
So, folks, when he says free, that means all you have to do is sign up at resiclubanalytics.com and you will get his daily, I think, free newsletter, which this is free.
Yeah. And so yesterday, Jerome Powell announced that the central bank would begin its interest rate cut. And, they announced the 50 basis point move down, a little more than some people expected. Even myself, I kind of thought maybe it would be 25 basis points, because when they started hiking rates back in March 2022, and that was with inflation going up to 6%, and by the summer it was 9%, they only started up with a 25 basis point move up. Now, the
Correct.
long-term yields at the times got ahead of everything, which they always do. But so a little surprising here, they went 50. And I think what that's an acknowledgement of is that weaker jobs report from the month, the July number that was
Yeah.
published in August.
Yeah.
And I think the Fed's essentially acknowledging, oh, the last meeting, they probably should have cut 25. So let's go and throw another 25 on there. And just because they start with 50 doesn't mean we'll stay at a cadence of 50. That really goes by, the data, right? There'll be data dependent on their cuts. But Powell said, we have in fact begun the cutting cycle now. He proclaimed on Wednesday. And this is my dual mandate tracker chart. And so this black line is the federal funds rate. This blue line is the inflation rate. And the yellow line is the unemployment rate. And so
Oh, I
the
like
Fed
that.
has a dual mandate: maximum employment and price stability. So you go back to 2022, this blue line inflation was taking off. Unemployment was very, very low, actually at a 50-year low. And that federal funds rate went up a lot. They went into inflation fighting mode. We have since seen a big deceleration in inflation. and unemployment is actually starting to move up, right? So we've gone from a
Correct.
cycle low of 3.4 in April 2023 to 4.2 as of the last reading. And
Mhm.
so now their attention is starting to focus a little less on inflation and a little more on employment. And historically speaking, when the Fed, when unemployment starts to rise, this yellow line, inflation's decelerating, and then the federal funds rate goes down, usually these light gray lines, usually you go into recession, right? We've
Yep.
had a few soft landings through history, so it'll be interesting to kind of see what happens here. There's a lot of arguments from some economists that, some of this unemployment rate tick up is because labor supplies increased so much, right? There's been so much immigration,
Mhm.
and there were these pandemic effects, and as they kind of waned, some of the supply constraints that were pushing inflation up also waned, and maybe we can achieve this much talked about soft landing. On the other side, the people are saying, hey, those guys always are coming up with reasons for why a cycle is going to have a soft landing, right? If
Yeah.
you go back through the past 30, 40 years and these different periods, you can find economists coming out and saying, hey, why this cycle is unique, why a soft landing. So that's kind of the other side of the argument.
Yeah.
But what does that mean for the US housing market? While the Fed does not directly set long-term rates and yields and the 30-year fixed mortgage rate, its policy and the market's assessment of where future federal funds rates will be in the future and where the economy is headed do impact the long-term yields and the 30-year fixed mortgage rate. And so this cycle, we've come down from the high in the Freddie Mac series of 7.8% 30-year fixed mortgage rate, which Mortgage News Daily got a little over 8, to 6.2 for Freddie Mac. And actually, we might have gotten an update on that one for Freddie Mac. Let's see. Oh, 6.09. Yeah,
Oh,
that's that just came out this morning at noon. I didn't see it
okay.
yet. So interesting.
So that's a cycle low, right? 6.09.
Freddie Mac series. Let's see what it was in April. Remember that 599 reading
Yeah.
in February? Yeah, I think it's a cycle low. Since rates, it ties it. So that week that
February 2nd.
we
Yeah.
got
Yeah.
that
Yeah.
one, yeah, 5.99. Yeah. So essentially the lowest mortgage rate since the fall 2022, September.
Okay.
And so groups like the Mortgage Bankers Association, Wells Fargo, Fannie Mae, Moody's, they all expect mortgage rates to come down a bit more as the volatility comes out of the market, as the spread narrows. Mark Zandi thinks it'll be 6.0 by the end of the year, and 5.5% by the end of 2022. And
25. 2025.
2025. Sorry, I've gotten like 3 phone calls in a row. So here I tracked the latest forecast. These were just updated yesterday with the latest revisions. You got Moody's the lowest. You have Wells Fargo down here, Fannie Mae, and also the Mortgage Bankers Association. Nobody's projecting like massive drops down, other than, and I don't know if they're still doing it, but Morningstar was the one who thought we were going to like 3.99
Oh my
or,
goodness. That would be
like
horrible.
2026 or into the 4s.
Yeah.
And the
It,
only way you get there, and we've talked about this before, is you probably have a recession.
oh yeah, there's no doubt. You go that low, we have a recession. Sure.
And so what does this mean for existing home sales? Fannie Mae said yesterday that they're ready to call it, that 2024 full year will be the fewest since 1995. So that title went to 2023, and the hope across the industry last year was that given that drop in mortgage rates at the end of the year, that existing home sales would finally have bottomed in 23 and gone up a little
Nope.
bit 24. It didn't happen. It
Nope.
didn't.
Did not happen.
I thought, with new listings at the beginning of the year, we're starting to show a little bit of improvement. And it was like, okay, maybe the bottom's kind of there. And then the new listings really dropped back down once rates went higher. And we started to see the market was no longer absorbing inventory at the same rate, given the
Correct.
slowdown in the Gulf states, the
Mhm.
condo inventory in Florida, some of the single family in like Texas and Louisiana started to build. So what does it mean here going forward? As mortgage rates decline, as we've seen over the past several months, it means housing affordability improves. If affordability increases enough and the job market remains stable, it could help ease the lock-in effect and lead to more turnover in the resale market. That
Yeah, well,
doesn't
this is something we really need to talk about. Because again, I think Jerome Powell is technically correct in his statement lower rates could balance the market. But what I think most people don't appreciate, another Zuber quote or whatever, is I think marginal demand unlocks meaningfully before marginal supply. What do I mean by that? I think you could see a wave of marginal demand, for example, at 5.5. I think a 5.5% mortgage rate is the absolute worst mortgage rate for the housing market because I think you unlock a gargantuan amount of marginal demand, but I don't believe marginal supply comes back in the same numbers unless you're at 499.
Well, so let's get into that stuff in the home price section.
Okay.
As we talk, that's kind of more that equilibrium between supply and demand.
Yep.
But for existing home sales, so far, people like Logan Motoshami and Housing Wire kind of argue there's been some improvement. You have to really be squinting at this
Yeah.
right now. Maybe he's
Really
right.
look.
Maybe he's right.
Yeah.
But mortgage purchase applications, a leading indicator for future homes, existing home sales, remain very low, right? But if mortgage rates stay close to 6 or a little below into the spring 25 season, so you got that,
Yep.
you have the duration of the lower rates
Correct.
for a
Yep.
moment. And so that gives confidence to these homeowners who would otherwise have liked to have sold their house and bought something else over the past 2 years that, hey, maybe rates are enough that you can stomach going from 3-4% mortgage rate and take on something a high 5 or a 6 flat handle.
All
And
right.
maybe
Well, let's just stop there. You happen to be one of these homeowners. You, Lance Lambert, got into a new home. You have a remarkably low interest rate. I believe you're welcoming a new child here soon, or just did. I forget the timeline.
just got number 3.
You
Yeah.
just had number three. What say
3-bedroom
you?
house.
Yeah. What say you? Are you thinking about going? Oh, we have a three. Can we stomach a six? That's just too big a jump for me.
Yeah. Yeah. And my rate's so low, it's like 2.6 that, you know, I don't know. You'd hate to
You're
give that
buying
up.
bunk beds. Let's just be clear. You're
Yeah.
buying bunk beds.
Well, yeah, I've already actually had to move 2 of the kids together. So,
Knew that
so
was coming.
yeah, so that's already happened. But yeah, and then when I do go to move, I'd like to be in a position to where I could probably just keep the house, right?
Keep it
And
as a
maybe,
rental.
yeah,
Accidental landlord. Yep.
yeah. And especially because I'm kind of into housing, I think I'd kind of like to
Yeah.
try go that route. And when you do the math, that rate really is an asset if you think about it
Correct.
that lens. And I did the math on the house. Like if I took the equity, put it into stocks, and then I only assumed that the home price went up like 3.5% per year,
Hmm.
it was still better to be a rental. It
Oh,
would stock market if
you should not.
based
Don't
on the
touch
math
that
I
two
did.
six. Yeah.
Yeah.
There's no reason.
And so if rates go low enough, maybe you bring some of them back, right? But if you go down to what Fannie Mae said yesterday, they're thinking about, existing home sales, given where they think rates are going to go, which let me go back to the rates. They were kind of let me see here. They're like 5.7-ish by the end
Mhm.
of 2025. They only think that existing home sales will go up 11% next
I
year.
will take the under. I will take the under. I'll take the
So
under by quite a bit, actually. I'll say 4-2.
yeah. So and yeah, I don't mean to call.
No, I
I'm
know.
just,
I make calls. You don't make calls. You report. I
but
make calls.
even if this Fannie Mae one happened, that's still very low. We were at
Yeah.
5.3 before the pandemic, and that's them assuming that rates come down another 50 basis points, essentially to
Mhm.
5.7 by
Yep.
the end of the year. And here you have mortgage purchase applications. Despite this move down in rates, we're still not seeing a lot there.
Nope.
And actually, the existing home sales print, which is a little lagged, mortgage purchase applications is ahead of it, but it
Mhm.
just came out today for August. And it's essentially the lowest one
It is
outside
3.86.
period in 2010 since 95. It's back to the cycle low.
Yep.
Okay, so let's talk home prices. On Wednesday, a reporter posed this housing question to Fed Chair Jerome Powell. Some of your colleagues have expressed concerns that with starting to cut rates, you could reignite demand in housing and see prices go up even more. What is the likelihood of that, and how would you react to that? I'm going to read his full response. Jerome Powell responded saying the housing market, it's hard to game that out. The housing market is in part frozen because of lock-in, lower rates. People don't want to sell their home because they have that very low mortgage and it would be quite expensive to refinance. As rates come down, people will start to move more, and that is probably beginning to happen already. But remember, when that happens, you've got a seller, but you've also got a buyer in many cases, a new buyer in many cases. So it's not obvious how much additional demand that would make. The real issue with housing is that we have had and are on track to continue to have not enough housing. And so it's going to be challenging. It's hard to zone lots in a lot of places people want to live. All of the aspects of housing are far more difficult. And where are we going to get more supply? And this is not something the Fed can really fix. But we are normalizing rates. I think you will see the housing market normalize ultimately by getting inflation broadly down and rates normalized and getting the housing cycle normalized. That is the best thing we can do for householders. And the supply question will really have to be dealt with by the market and also by the government. And by the government, he didn't say federal, state, or maybe
No,
even
it's local.
talk
Yeah.
about zoning. And so Powell didn't say whether he thinks lower rates and more turnover in the resale market could put upward pressure on prices, but he also didn't rule it out, right?
Yeah.
And if you go back to this part of the comment, he starts off with the housing market. It's really hard to game that out. He's essentially saying he's not really sure,
Yeah.
right? And I think if you assess all their comments they've made over the past few years, they've been surprised at the resiliency in housing in terms of the price and rent side, right? And
Mhm.
that's the stickiest component of inflation. And I think they're acknowledging that they've done this huge move up in rates. Housing maybe hasn't decelerated as much as they'd like, but there's only so much they can do because of the supply side. And now,
Yep.
as they ease rates, because they don't want to hold them too long and derail too much building, right?
Yep.
Because that makes things worse potentially long term. But
Correct.
as the pull rates down, they're kind
Here's
of
here's here's the deal. They broke the housing market, whether they want to acknowledge it or not. They kept rates too long. They were the largest buyer of mortgage-backed securities for too long. They've created such an air pocket. And then they took rates up faster than they've ever done before, which created the lock-in, create the accidental landlord. Um, it's it's going to be broken. And really the only answer is what I told people 2 years ago and a year ago and 6 months ago is we're going to go sideways for quite a while. Transaction crash, yes. Price, no. And we're going to need years to get through this broken housing market. So again, I love the fact that you're on top of this, Lance. Why don't we spin gears to something you are launching, the first ever ResiDay in New York City? What's up with that?
Yeah. So in let me see, November 8th, I'm going to do an event called ResiDay. It's in New York City. Really want to bring a lot of the brightest minds around the housing market together for this one-day event. Single family landlords, developers, lenders, brokers, people who really want to be a part of shaping where residential real estate is going heading forward. And also them personally are just invested, they plan to invest themselves and their time and energy in the sector long term, right? And so this event, will help lead a day of insightful discussions with market trends and strategies impacting the housing landscape. I think there will be a lot of great speakers there. We're going to have you there, Zuber. Thank you for going. We'll have people like Gary Beasley, the CEO of Roofstock. They manage, I think it's like 20, 30, 40,000 rentals. They do all of Invesco's now. And they're a really big player also on the mom and pop side, but also the institutional side. CEO of Lending One will be there. I'm going to try to get some different people across the sector and different spaces to really give different points of view. I've went out and found a few different interesting founders of startups that I would like to be there, so people kind of see what's up and coming through the industry. One of them is, creating a site to kind of find inventory that is not on the MLS. It's also not off market, but it's like that other side where it's like, maybe I would sell my home if the right dollar came, but I'd have to get the right dollar. So that part of the inventory is where they're finding, and people can essentially go to the site, name their number, and just be listed there. So you can kind of dig through and find more inventory potentially. So things like that. And it's going to be in New York City. It's over in like Hell's Kitchen area. It's a 1-day event. The tickets are pretty cheap. It's $75. And any Resi Club Pro members, my paid tier, they can attend for free.
Yeah, it's gonna be a lot of fun. Look forward to the opportunity. Lots of networking, lots of data, everything, housing. Lance is the guy. If you're in New York or can get there by train and you're not there, shame on you. If you are a One Rental at a Time fan and you have my book, either of them, bring them. I'll autograph. We'll take some pictures. I look forward to seeing lots of folks there. Any closing thoughts?
Yeah, I want to do one more chart. So the most meaningful change in housing so far is actually refi,
Yes.
traditional refi. And what it is that the people who bought over the past 24 months with the 7 to 8% rates, they're now actually starting, some of them, to try to go out and get some relief, right? And so the mortgage refinance index, it was at 900 in September 2018. 2,300 in September 2019, 3,300 in September 2020, 3,200 in September 2021. That's refi boom right there.
Yeah,
That's
peak boom. Yeah.
refi boom.
There are people that refi 2 or 3 times in that window.
This is refi hell. We've
Yep.
actually never really been to this point.
Yep,
So
that's losing 50 or 60% of your mortgage brokers have left the business because they're in refi hell. Yep.
Yep. And so really low 500 index reading September 2022, 400 September 2023, 941 last week. That's the highest since rates spiked. It is actually back to 2018 levels. Remember when rates briefly got to 5 and people were terrified and people were talking about market crash then, and home prices now are like what, 60%, 55% higher than then.
Yep.
But now we're still well below 2019 levels, but we're starting to get up. And CoreLogic estimates that there are 4 million homeowners that could refi now that rates are down to 6. And what does that mean? There are 4 million mortgages in the US that are at least at a 6.7. Because to be eligible, they make sure you're 70 basis points is how the CoreLogic and ICE math works.
Okay. All right.
And so that's 4 million. Now, the good news for the refi and the lenders is that it's starting to move up, and there are 4 million of these people who are eligible. And if you get it down more, you can get a few more million potentially, right?
Yep.
The bad news, 76% of outstanding mortgages still have below a 5% interest rate.
Yeah.
And so the potential for a long sustained boom in traditional refinancing, it appears to be limited compared to past cycles. And so that's one of the points I've been trying to bring up to people, which is, hey, refi is moving up. It's one of the areas of housing that's been the most meaningful, but also keep in mind that, it probably has a ceiling relative to some of the other past cycles. Because think about when rates go to 2%, every mortgage, all of them, right, or refi, right? And so from the early 80s into the 2021, that long period of rates moving down with a few interruptions, a huge, massive pool of rates could be refied, right? Traditional refi in this environment is just not going to have the same type of macro setup. Now, the thing that we will probably start to see in the area of opportunity here, and is that the second mortgages, the HELOCs, these other products that tap into equity, that side probably will get more momentum, and it has already started to get
Sure.
momentum. HELOCs topped in 2008. They bottomed in 2022, the first quarter, and they've since been on a gradual rise.
Hmm.
Now,
Interesting.
taking out HELOCs the past couple of years, rates have been high. That's kind
Hmm.
of, you're kind of in a pinch if you're doing that, I think.
Yeah.
As rates come down a bit, you might see some of that, some of those products in the equity, second mortgages and those equity products start to move up a bit.
Yeah, I love all of this. You are housing, housing, housing. Remember, folks, go to ResiClubAnalytics.com, get your free newsletter. Also, if you're in and around New York, you better be at ResiDay. I look forward to seeing their autographs, pictures. Lance, you're amazing. We'll talk next week.
Yep. Thank you for having me.
You got it.